So good afternoon to Europe, good afternoon to the Americas, as we are mainly operating between these two continents. I'm Paul Dembinski. I'm professor of economics at the University of Fribourg and also the director of Observatoire de la Finance here in Geneva. Together with the Graduate Institute and with the Center for Monetary and Banking Studies, we co-organize this series of seminars to commemorate, to reflect on the 50 years of floating exchange rates. So my warm welcome to the four panelists. Thank you for being with us, despite your different time constraints. And this is the second roundtable of the series I mentioned before, looking back to the 50 years of floating exchange rates. Last week, the first panel discussion addressed the historical context of the 1971 decision, its causes and its consequences. The recording of this fascinating conversation was moderated by Rui Esteves, is now available on YouTube and the different websites, and will be shortly on the different websites of our institutions. In moderating this session, I will be assisted by Dr. Virgile Perret, who will take care of Q&A. Participants are kindly requested to use the Q&A device, and Virgile Perret will channel the questions to the panel in due time. This is all for logistics. Let's move to the content side part of the panel. As it is the second panel, we have a new set of questions. The questions that we should answer, we should reflect on, is what problems did the floating exchange rate solve? What problems did it create? What have you learned about the pros and cons of different policy regimes? And for this, we have slightly less than 90 minutes. So of course, we will not exhaust the subject, but I hope we will touch on the most important elements of it. Our panel combines a variety of perspectives and also a variety of personal experiences. Before giving the floor to each of the four panelists for their introductory remarks, let me briefly introduce each of you. And of course, then in your speech, you can complement what I missed out. Today, as we know, we have the International Women's Day. So it is a good reason to start with introducing Paulina Restrepo Echeverray, who is, I understand, Colombian-born, but macroeconomist, senior macroeconomist at Federal Reserve Bank of St. Louis. She is also adjunct professor at Washington University in St. Louis and associate editor of the Review of Economic Dynamics. She is working also with the Colombian government on potential GDP committee. She is a specialist in macroeconomic questions and has some interest in capital flows and sovereign default. And also, it is not so macro, search theory, and labor economist. Paulina is going to speak today, despite the fact that, if I understand, you are in the blackout period. So we're not going to touch too much on current issues of international implication of the present situation. Then we have Ashoka Modi, who is Indian-born, if I understand, who is a Charles and Mary Robinson visiting professor at the School of Public International Affairs in Princeton University. And previously he worked at the IMF. You have also been working at the World Bank. Then we have Ladislau Dowbor, who is economist interested in financial matters, professor at Catholic University in Sao Paulo, and consultant for many of international organizations on macroeconomic and political economy issues. In 71, if I understand properly, Ladislau, you were a prisoner, political prisoner under the military regime of Brazil. So you have differentiated memories of the 71 events, I guess. But afterwards, you have been also advising President Lula on economic policy issues. And finally, we have on the panel Charles Pictet, who is a banker. 50 years ago, he was already in a managing position in the family bank. Then he was a managing and senior partner of this bank before joining the Swiss regulatory agency, the FINMA, when he served until 2012. Since then, he was back in business. He is sitting on a number of boards of professional associations and also on charity institutions in Geneva and in Switzerland. So this is briefly introduced our panel. And now time has come to give you the floor for your short opening remarks. And I will start by giving the floor to the last mentioned, namely to Charles Pictet. Charles, please go ahead with your opening remarks.
Tac, je suis bon. Okay, merci, cher professeur. Just would like to make two little points before I start. I was in the United States working in New York when the Bretton Woods Agreement was unilaterally terminated. And my professor at that time, who was a chief accountant of the SEC and also became the dean of the Columbia Business School, had great problems to teach the devaluation for students, because when you had to consolidate a foreign subsidiary into the US parent company, the accounting rules were did not exist. This is for the students, so it was total nightmare for everybody. Second point, interestingly enough, is that today the gold price is the highest in its history, at least in dollar. And my godfather was a president of the Federal Reserve of New York. And so I had the opportunity to visit the gold in the bank in New York with the gold held by the different countries. So it was an interesting period. So for the introduction, I would say that thanks to the Bretton Woods agreement, which was finished, America could keep their gold reserves. And remember, it was quite important that even private citizens were not allowed to hold physical gold at that time. Then the export should become at least theoretically more competitive. Third, the dollar kept its role as a world currency reserve thanks to the economic and military power of the country. And the continuous devaluation of the dollar had no negative consequences domestically. It was the beginning also of the dollarization of the world. Now, on the negative, for the other countries, it was a problem. Indeed, the surprise and the shock was enormous. The world saving invested in the US, in particular for the debt market, lost with the devaluation about 30% of its value within months. Inflation went up dramatically 2 years after, and provoking a strong rise of the interest rates to unprecedented level. So the foreign owner of the dollar-denominated bond would lose both on the devaluation of the currency and the rise of the interest rates. So a 40% loss was generated in foreign portfolios. On top of it, the stock market suffered for the same reason. However, on the positive side, you should remember that at that time, few currencies were fully convertible. The sterling, the Deutsche Mark, the Dutch guilder, and the Swiss franc. But these were small domestic markets. Interest payments were taxed, and the administrative hurdle was very high. It was not suitable for the need of the capital market on international level. In 1959, a group of financiers launched the first international bond issue for the Italian Autostrade, $30 million. It was the infancy of the euro dollar. And then was the question, of course, was the euro dollar a US dollar or not? Was it would we have $2 or not? This was a question we had at that time. Now, in order to create an international market, a large supply of dollars was required. The other currencies mentioned before were not suitable, maybe the sterling. The current account imbalance of the US played this role. To develop the world economy, a large flexible market was necessary. The key for an efficient market is its liquidity. You want to be able to sell what you have bought with a minimum of cost. And liquidity depends on size, confidence, and proper infrastructure, like the Euroclear, for example, for the bond market. So the combination of a large tax-free market combined with a US Treasury bond was a fundamental basis for the development of the financial market we know today, i.e. the euro market. Voilà, mon cher.
Thank you very much for this. You touched on many issues on which we are going to probably come back in the conversation. Let me turn now to Paulina Restrepo for your initial remarks. Please, Paulina.
So thank you very much for inviting me to participate in this very interesting roundtable. I want to start by, well, the first thing is, as Paul correctly stated, I am in a blackout period, so there might be some issues that I won't be able, unfortunately, to comment or expand on. Let's hope that it's not very restrictive. So I want to kind of come into this with a different perspective. I'm going to highlight the importance of the political side of things on how the actual Bretton Woods Treaty turned out to be and the effects on the real side of the economy. So basically, during the Bretton Woods era, there were forces that could have forced capital flows out of developing countries, which would have been rather destabilizing and damaging. So basically, what we see is that the US was willing to trade off the benefits of having all these capital inflows in exchange for geopolitical stability. In other words, if one wants to coordinate economic stability, you have to give up economic autonomy in some sense. And more specifically, what we see is that when we're standing at the end of the Second World War, the US wanted to promote ally reconstruction, they wanted least developed country growth, and they wanted to support their friendly governments, and as well as wanting to prevent hostiles, initially Nazis and then Soviets later, from influencing other countries, especially Latin America. And so the US viewed international capital markets as prone to crisis, and we know that crises drain capital, they depress growth, and they create political instability. So something that I want to highlight is that the Bretton Woods system was not only about the fixed exchange rates, but it's like if you have a coin, the coin has two sides. On the one side, you had this exchange rate pegs, but how do you maintain those pegs? In order to do that, they had to instate impediments to international capital mobility or capital control. And so something that I studied for a long time is what were the consequences of those capital controls. And so what I have found in my research with Leo Hanian from UCLA, Mark Wright from the Minneapolis Fed, and Diana Van Patten from Yale, is that as a result of those capital controls, the US lost around 4.4% of consumption equivalent terms from participating in the treaty. So basically they lost consumption in relative terms to the rest of the world, while Europe gained around 1.3% and the rest of the world gained around 4.5%. As I said, these are all welfare calculations in terms of consumption equivalent units. So if you ask me, what have we learned of the pros and cons of policy regimes? I would say that even though we might see the cons on the economic side, in this particular case, given what we have found in our own research, viewed from the perspective of the United States, because they lost in relative consumption terms, there were pros from the political side, because they really wanted capital to stay in developing countries to support democracy and to avoid communism. And I think they were successful. So it's hard to think of a counterfactual from a political standpoint that would tell us what would have happened if capital had been able to flow from the rest of the world, especially Latin America and the Asian tigers, to the US. What would have happened to consumption? Maybe it would have been the case that the US would have the US consumption wouldn't drop as much as we saw it did during that era, but we don't know what would have happened on the political side and what would be the state of democracy in present time. So having said that, in summary, basically is, okay, I think that a lot of times the geopolitical part of things really plays a big role, and it's not just about the economic side of things. So the pros and the cons can come in the two dimensions. And that's kind of what I want to put out there to start with.
Thank you very much for making this important political economic point and bringing the two aspects in balance. So Ladislau, can I give you the floor now for your introductory remarks? Voice stemming from Brazil.
No trouble. Thank you, Paul. Thank you, everybody. I am from the south. I'm here in this shirt. We have 33 degrees at this moment here in São Paulo. It's warm. And Paul, when I heard of the August 71 decisions, I was in Paris. I was had just been freed from prison, and I was reflecting on the freedom, free-floating exchange rates, and all this. This was a time, Charles, we were reading Servan-Schreiber, Jean-Jacques Servan-Schreiber, on the Le Défi Américain, the American challenge. Yes, and I remember De Gaulle summed it up, all the system. He said, nous les payons pour qu'ils nous achètent. We pay them so they can buy us, because the US were printing money now free for all, and they were buying businesses around the world, and this is one key issue. Yes, this free for all system, and in my view, a general financial loss of control is starting at this time. Second point, let's say, I will take the image right now in Brazil, because this is the same process. We have this free-floating exchange rate, and the dollar now in Brazil is at 5.5 reais. It was less than half, let's say, 5 years ago. So at that time, an exporter in Brazil, for every dollar exported, he received 2.5 reais. Now he receives 5.5 reais. So we have a general reorientation of our production system. We have deindustrialized. The industrial part in GDP fell from 23 to 11%. And we have an explosion of export of basically commodities, raw materials, agriculture, and so forth. And this is dramatic, because there is little control on this exchange rate, because we are linked in an international system with the big asset management groups. So this is a key issue. To give you a very concrete example, this is dramatic for Brazil. Brazil presently has half its population going hungry. This is the level. I mean, what we call food insecurity, 116 million, and going hungry directly, 20 million. Because, and we produce more than 3 kilos just of grains per person per day. So there's no reason whatsoever for it is not the production, it is where it is going, and it is going where it pays more, and this is linked to floating exchange rates. Let me say that it is a third point, that it is linked to financial power. The asset management industry, BlackRock manages assets of $10 trillion. This is 6 times Brazilian GDP. They have a heavy hand on Brazil, as well as Glencore, and as well as State Street, Vanguard, a series of them. So we have this finance industry, which in a certain way, the financial profit logic is essential, is redirecting the productive systems. This has been called that the tail wags the dog now. You have an inversion of the system. And I would just comment, linking it to what Jacques de la Rosière said at the former meeting, that the financial system is not going to productive investment. This is a key issue, and this is very strongly seen in Brazil. There is a recent study on the European Union where only 3% of financial assets are going to productive investment. For me, this is a financial chaos, and we have no control because finance is global and the national governments, the regulation capacities are very low. For me, we are facing dramatic challenges in this area. Thank you.
Thank you very much. And you mentioned the euro, and I think that Ashoka Modi has a lot of things to say because he's the author of the very well sold book about the euro tragedy, and you are adding chapters, if I understand, to every edition you add 1 or 2 chapters of this euro tragedy. So Ashoka, please, the floor is yours.
So, well, thank you very much for having me. I guess I am an unapologetic messenger in favor of floating exchange rates. I'll make 3 quick points. One, that the Bretton Woods itself, in my mind, was an intellectual inertia of the gold standard period. The gold standard had broken down in the interwar period, especially in the Great Depression, and the conveners at Bretton Woods wanted to mimic something like the gold standard, and so they created this pegged but adjustable. The problem with the pegged but adjustable, as Paulina intimated briefly, was that instead of being guided by economics, it very quickly became guided by politics. And this is a theme that Milton Friedman picked up in 1953. And the key problem was that once you have a peg, there is a grave political reluctance to depreciate the exchange rate when you desperately need to do that. And so countries would postpone the depreciation of their exchange rates, and that postponement then would lead to chronic imbalances in the balance of payments and would, in the end, cause dramatic crises and/or very disruptive outcomes. So Friedman recommended floating exchange rates in 1953. It took until 1971 for that to happen. 2 examples of why I believe in floating exchange rates. First, floating exchange rates are a crucial shock absorber. When a country suffers from an economic shock, there is a temporary disruption, and the exchange rate is the most efficient way of dealing with that disruption. So take Europe, for example. Europe is the only continent in the world. Europeans are the only countries in the world at this point that still have fixed exchange rates. They call it a monetary union. I call it an incomplete monetary union. The rest of the world has moved on. Even within Europe, the United Kingdom, I don't know whether we call UK Europe still, Sweden and Poland, did well in the 2007-2008 financial crisis because their currencies could depreciate and absorb the shock. In contrast, the Eurozone lingered on for several years in a frustrated policy effort, which in the end caused a lot of grief and some long-term scarring damage. The shock absorber element of the exchange rate is a temporary element. But sometimes there is a somewhat longer perspective on why exchange rates are valuable. And the countries that have most effectively used that are the countries of East Asia. So starting with Taiwan in 1957, Korea in the early 60s, China in the 80s, 90s, Vietnam more recently, they have followed a dual strategy of jumpstarting their development process. A typically undervalued exchange rate to gain international markets and a plentiful supply of excellent human capital to supply those markets. And it has been a repeatedly successful strategy over the last post-war period. Japan started it in the 30s, and that is why Japan is in some sense the pioneer of that strategy, but the East Asian countries have adopted it. I'll make one final statement. I'm currently writing a book on India, and I see the pitfalls of an overvalued currency, especially when contrasted with the East Asian experience. When an exchange rate becomes a political instrument, it becomes a symbol of national honor. And any depreciation of the exchange rate is considered a slight on the nation. And that attitude remains so deeply ingrained today, even in India, after more than 20 years of floating the exchange rate. If the rupee goes from 75 rupees to $1 to 76, there is national mourning in India. In my view, the rupee should be closer to 100 rupees if India has to make progress in grabbing a larger share of international trade. Today, Vietnam is a country of over 100 million people, has a larger share of world markets than India with 1.4 billion. So an exchange rate is a very valuable instrument. Depoliticizing it is the crucial element which floating exchange rates achieve. And that is why I remain firmly committed to that notion. Thank you very much, Paul. Thank you very much.
Thank you very much, Ashoka, for your comments. And now we have made the first tour of statements. I think there are many questions that arise from what you say. And I would like to maybe to pick two questions to all of you. One is about the lessons. The general expectation, theoretical expectation was that flexible exchange rates will solve the problem of imbalances. But we live still in the world of imbalances. So what can we say about this? What kind of lessons can we draw on this point? I think that Paulina had some points in a preparatory conversation. You had some interesting points about this. So could you come back to this issue and then open up the conversation among other panelists?
Yes, so I think that there are two things to mention. One is, I mean, and I guess what I will address later is, the term imbalances. What does it even mean? But when we look at net exports during the Bretton Woods era, and take, for example, net exports for the US then take Europe as a whole, and then take the rest of the world and think of the rest of the world as mainly Latin America, East Asia, Canada, Australia, New Zealand, we see that actually net exports were very close to zero during that period. So what people refer to as imbalances, when you think about aggregate net exports, in the net, we're not really there. So something that the system did do was to put capital flows when measured by net exports very close to zero. Now, when the system ended in 73, that's where we see huge divergence in those net exports. So we do see those, quote unquote imbalances after the end of the Bretton Woods system. And I guess what you were kind of pointing towards to is we had a previous conversation on how I'm very much against the term imbalance, in the sense that what is an imbalance? Because an imbalance has a negative connotation, is something that we think as being something that is in some sense in my mind out of equilibrium. But capital flows around the world are actually a result of allocating capital in the best way possible, given existing distortions in the different markets. So think about domestic labor markets, domestic capital markets, and international capital markets. So when we think about capital flowing around the world, it will do it in an optimal way, given those distortions. And then when we call something an imbalance is when we go and look back and we see that there was like a very big capital inflow, for example, to any particular region, or a very big capital outflow from that particular region. And then we judge that as being something negative for the economy. And so my view is, well, I don't think we should judge that as being something negative to the economy. Imbalances, I don't think, should be viewed as, something pejorative or negative, or they are just a result of an optimal allocation of resources around the world, given the existing distortions. And it's always a term that we kind of use ex post. And I think that when we were talking about this, I used as an example the Latin American debt crisis of the 80s, where we see all these countries had accumulated a certain degree of debt. And we know that all the countries in Latin America, with the exception of Colombia, defaulted on their debt. And so we go exposed and we say, well, there were very large imbalances, a lot of capital flew into Latin America, which in principle shouldn't have. But then what tells us that it shouldn't have? At the time, those allocations were the proper ones, because the alternative was really for capital to flow into Asia. And what we see is that Asia during the 50s and 60s had very large domestic labor market distortions that made it suboptimal to send capital into that region, while Latin America did not have this issue. And so, it was an optimal decision by investors, which exposed, because of political reasons and other things that happened at the time, ended up, in a very big sovereign default by Latin America. But, at the time, it's very hard when things are happening in real life to call the shots and say, oh, that's going to be, a negative or capital flows are flowing in the wrong direction, and we're going to view it as an imbalance. So in other words, I think that, if I try to think of a model that would tell me, that there's an imbalance, or that there's a certain amount of capital flows that are not good for any particular economy, it's hard to find because they are an equilibrium allocation. So I think that, whether we see balances or imbalances depends a lot on, what is optimal and what impediments to international capital flows allow during the time.
So thank you. Don't worry about imbalances, you're saying, de facto, huh?
Yeah, I mean, I guess I don't want to say in general, you don't have to worry about capital flows. I guess the term imbalances is what kind of really gets me, because for me, it's just an optimal allocation. Then we can discuss, should we prevent capital flows or not? Because as I said, I think that from the point of the US, specifically speaking about the Bretton Woods era, we see that from a political standpoint, those controls, those capital controls were optimal because they were trying to achieve a geopolitical stability that they wouldn't have been able to if they had not applied those capital controls. So there might be reasons why we want those controls. I'm not saying that there's no, right? The question is, what we see naturally flowing around the world as capital flows, it's hard for me to say it's an imbalance, it's just a result of an equilibrium allocation. And then we can think about, okay, do we want capital flows or not?
Thank you. Somebody wants to pick up on this issue of imbalances? Yes, Charles.
Yes, I understand what was mentioned about these imbalances, but there is one thing which is key, is that the dollar, which was at the beginning of the imbalances, is a world currency reserve. If it was not the case, or if there were other currencies challenging it, like the renminbi or the euro, and then a problem of confidence disappearing, then this question of a world currency reserve it will be put in question again, and would create the imbalances you see from your side a big problem.
Thank you. Ashoka, you wanted to join?
So I will make two comments. One is that while I'm sympathetic to Paulina's idea that imbalances are not always bad, and that sometimes countries will run current account deficits because they want more capital, or it is a reflection of more capital coming into their countries. That said, I do think that there can be bad policies that continue to hide behind those imbalances, in which case the notion that a large deficit may potentially be a good thing does not work for me. To your broader question, Paul, on floating exchange rates were meant to sort of get the imbalances to evaporate. I don't know that history as well, but I think that if that was the claim, it was a misguided claim. There was no reason to expect that floating exchange rates will solve all problems. That floating exchange rates, as I have tried to remark in my initial comments, serve two purposes. They are a shock absorber for the nation, and they can be, for a short period of time, a part of a development strategy. But the idea that floating exchange rates will disappear the imbalances, I think is extremely far-fetched. We are not going to get the world's capital flows to disappear. And as long as there are world capital flows, there will be imbalances. And in fact, as Mr. Dowbor said, that maybe floating exchange rates actually exacerbate capital flows. So to that extent, I would just remain somewhat less ambitious on what to achieve. A policy instrument achieves a certain minimum number of things, and to expect more from it is very unrealistic.
Thank you. Ladislau, do you want to join?
Certainly. I am very sensitive to Ashoka's comment on a patriotic approach to national currency. I mean, defending the country. This is very important, and this links this so-called free floating to political power. I use, of course, the Brazilian example, but we have a banker in the central bank, and a private banker, and a private banker in the Ministry of the Economy. And when they raise the interest rates in a fantastic level. Yeah, the international groups, asset management groups, they just take loans at very low interest rates in one country and use this carry trade system to gain huge financial gains in Brazil, draining the country's capacity. And this means that finance is linked to politics also. So this key issue is, of course, that the financial system must help development. Means finance at low interest rates for families, finance for investment, productive finance, because this system isn't working. Yes. Now the floating exchange rate that favor exports. We had at the time, we said it is important to export, importante exportar, with these words. The key issue is what you export, what you're financing. I've lived this, I've worked 7 years in different countries in Africa. And this was a drama, yes, because the financial system is not serving to finance development. Basically, it's a draining system. This is for me the key issue. In Brazil, we know perfectly well that we should manage, let's say, another dollar to real level, but the political power of these huge groups, both national and international, just doesn't allow for this. You know, we had a military a coup in 1916. They brought down a government, and this is interesting because in Brazil, exports is just 10% of GDP, so it shouldn't be so important. But what has taken over is the financial flows.
Thank you. So on the beginning of the conversation, some of the panelists said flexible exchange rate allows to depoliticize the issue, and now we hear that it's not necessarily the case. So it depends on the experience. It depends very much probably on the working of the internal political system and also on the place the country plays on the world agenda.
Yeah, so Paul, I would just make one clarification on that. I don't think floating exchange rates or flexible rates ipso facto by themselves politicize things. The politicization that your other panelists are talking about is coming from the financial markets. And the financial markets have become a law unto themselves. And their politicization is not related in any way, or at least not principally, to floating exchange rates. Yeah. In other words, if there were fixed exchange rates, the politicization, in my view, would have been much greater. There is no reason to believe that politicization of finance would have been any less if there had been fixed exchange rates.
Okay, thank you. So Alexander Svoboda, you wanted to say something, so please unmute one of the members of the organizing committee, Alexandre.
Okay, let me make just one point here, which I think the discussion is that any system can work successfully if the participants, whether fixed or floating exchange rates, play by the rules that that particular exchange rate regime implies to be stable and function. So if you want fixed exchange rates, you give up your monetary autonomy except for the big dominant country. If you don't want to do that, then you can't have fixed exchange rates. That's basically why they broke down. As for flexible exchange rates, you're supposed to abide, as Ashoka said, by the rules. And if there is any problem, but you also have to devote other tools for imbalances besides letting the exchange rate float. And remember that under the when Friedman wrote, he wrote in 53 in a world in which there were practically no capital movements, or they were very much controlled. And I think what is happening is once capital movements are there, things get much more complicated, and it takes particular rules to run the flexible exchange rate system.
Thank you, Alexandre. I think it's a very important point, because next step, I would like to consider the relationship between finance and exchange rates. Is it a coincidence that the development of financial innovation, of financial technology, occurred more or less in the same period where the fixed exchange rates broke down? Can we speak about the kind of causality? Can we speak about the consequence? What is there a relationship between one and the other? And in the short term, and of course in the medium term, because the new element on the picture of international economy are international financial markets that grew exponentially during the last 50, 30 years, 40 years to be precise. So what is the relationship between development of financial markets and flexible exchange rates? Causality or consequence, or no relation, just pure coincidence? Charles, do you want to pick on this one?
Now it's working, yes. Well, it is clear what I said before, that a tax-free market where competition exists with a minimum of regulation, and again with market makers provided liquidity, would make borrowing easier and cheaper. And therefore, in such an environment, financial innovation can only explode, with also the negative effect, because when you go one step too far, you have the crisis of 2008, clearly. And it was dramatic because liquidity disappeared very quickly, like it's happening today, in fact. And then the market has no escape issues, and so the things collapse. But one small comment about the interest rate. We have seen, when you see this float of money we mentioned in Brazil, this flow of funds, they were created now not only because of the imbalances on the dollar side, but also by the ballooning of the central banks. Why? Because they wanted their currency to remain not too strong to help export. So we are coming to the politicization of the currency exchange through the interest rates. And in Switzerland and in Europe, we even have still today negative interest, short-term interest rates. Thank you.
Thank you. So relationship between finance and exchange rates?
So I'll make a quick comment. Paul, is that okay?
Yes, please.
Yeah. So number one, your broad historical characterization is obviously right. But let me just say that even during the Bretton Woods period, capital flows were quite consequential. And when I read the monetary historian Michael Bordeaux, he makes the point repeatedly that what was testing the Bretton Woods system was in fact capital flows. And they may not have been on the scale that we now have, but they were substantial enough to test the pegs. Of course, that became much more prominent feature in the late 70s when the European monetary system broke down. And the key point over here is to go back to Professor Swoboda's comment that yes, it is true that if all countries play by the quote unquote rules, then any system is workable. But the point is, are those rules sensible rules? And what the lesson we learned in the breakup of the EMS was that if you need to give up domestic macroeconomic policy flexibility, then a fixed exchange rate system will break. And we saw that so graphically in the exit. First, I forget the exact sequence. I think it was the UK first and then Italy. That was the problem. The problem was, and that's what Soros was betting on, that the pain domestically will be unbearable, and therefore sticking to a fixed system will not work. So the rules have to be sensible. And on the latter part of your question, which is that the explosion of finance that we have seen in the last half century, is that related to fixed floating exchange rates? I do not see any link. I think that explosion was already set in motion, perhaps in a modest way, in the early post-war years, and it was in its nature to explode. It's exploded domestically also. If you look at the work of this fellow at NYU, gosh, I'm forgetting his name, the French economist, he tells you about how large the financial sector has become even domestically. So I don't see why it was not inevitable that it would become large internationally.
Thank you. Paulina, do you have some views on the relations, on the nexus?
Yes, I do. I want to kind of go back a little bit to something that Ashoka said, which I think is it's a great statement. He said, bad policies hide behind those imbalances that we see. And so I want to link the two issues here. Because I think that's I 100% agree with that statement. And I guess that my issue about the imbalances is not about the imbalances per se, or me saying that imbalances don't exist or are not bad or are not. It's about semantics. It's about the fact that we call them imbalances, because those policies, which can be good or bad, dictate the direction of capital flows. And then they dictate what we end up seeing in terms of current accounts, net exports, et cetera, et cetera. And then when we see very big movements in those, we call them imbalances. Okay, so my point is, it's whether to call it an imbalance when it's actually kind of an equilibrium allocation in response to those policies, which certainly can be bad, right? They're not necessarily good. And so this takes us to this point under discussion right now, which is financial development and fixed exchange rates or flexible exchange rates, which is, let's go back to the fact that to be able to sustain those fixed exchange rates during the Bretton Woods system, there had to be impediments to international capital mobility. So there were these capital controls that if you measure them, actually, when you start in the 50s, they start getting stronger all the way to the start of the 60s until they start easing off around 66 for Europe. For the US, they ease off a little bit earlier than that. But then we also see then the rise of the euro-dollar market. And so if we think about financial development, we see that the euro-dollar market grew 252% from 75 billion in 2020 dollars to 264 billion between 1964 and 1969. This is a tremendous growth. And this is still the time where we had the fixed exchange rate or the peg, because it was only, at the end of that, it's around 70 where countries started, dropping off of the system. So I think that if anything, there was a lot of financial development in order to get around those impediments to international capital mobility imposed by the Bretton Woods system. And so, this helped the financial development. So if anything, I think it would be a cause of the collapse rather than a consequence of the collapse, because we see it happening from earlier on.
And Charles mentioned the question that bankers were asking themselves, to what extent facing euro-dollar markets, there was $1 in circulation or $2 in circulation. Maybe you can just substantiate a little bit this, Charles, for the audience.
Yes, as asset managers, the issue was when you have a euro dollar, are these dollars valid in the United States? The question were in the Eurobond markets was tax-free, whether the interest payment would be paid in the United States or not, because it was offshore sort of the United States. And so when we bought bonds, we were looking whether there were interest payment in Canada possible, so that it would be viewed as a real dollars and not a split currencies. Because obviously what it was mentioned before, this rise of the dollars were created somewhere by the imbalance of the United States before Bretton Woods and after, because dollars were not created in Europe. They were based on the imbalance of the United States. This is just to make a comment of the previous speaker. Thank you.
Thank you very much. So now we are going to turn to the question of the audience, and I introduce Virgile Perret. Could you turn your camera on, Virgile?
Yes. Hello, everyone. Can you hear me? So we have approximately 10 questions. I will start with a question by Noemi Orna Levy-Orlik. She's asking, is it okay? Yeah. She's asking, would it be conceivable to go back to a system of fixed exchange rate? And how do you measure a correct exchange rate if financial capital is so important? So I submit this question to the panel. I don't know who would like to step in to answer. Well, I believe you.
I will just make a very quick comment. Given that, you know, I formerly was an IMF official, the right exchange rate, knowing what is the right exchange rate is impossible. Okay. The IMF does some very fancy footwork in terms of trying to figure out what is the right exchange rate. Is the exchange rate overvalued or undervalued? And there are various methods of doing it. And even those methods produce different results. I think the question is not so much whether we know what is the right rate, but whether there is a political commitment to that rate. The problem arises not, obviously there will be periods in which the exchange rate will overshoot or undershoot because of capital flows. But the real problem arises when a country makes a political commitment to a certain particular rate. And that's when the markets then test that commitment mercilessly. And that merciless test is what then causes all kinds of domestic economic management problems.
Thank you, Ashoka Modi. Then we have a question of Usama Wakil asking, what does the panel suggest for those economies where the impact of currency depreciation on their elasticity is lower, according to Marshall-Lerner condition, as we are experiencing in Pakistan economy? So I submit the question to the panel. I don't know if anyone has a comment or would like to reflect on this. I can repeat the question, maybe.
I would like a simpler question.
Okay, so then I will switch to the next one. I have a question of Alex Castaldo to Ashoka Modi. He's asking if he was referring to Thomas Philippon, the French economist at New York University.
Yes, I was. Thank you very much for reminding me. Yes, he's the most prominent person who has who has described the sort of evolution of the financial system in the United States and the kinds of problems that arise. Yes, thank you very much.
Okay. Then we have another question of Brian Bethune. It's a bit long, so I should maybe summarize, but he's asking the question, the relationship, his question in the relationship between capital flows and the system of exchange rate. And he's asking, first, he's first making the comment that capital flows are optimal when they imply that the flows respond to differential rates of return on capital. However, he takes a few examples to say that capital flow, for example, within the Eurozone, like in Germany, did not primarily go into productive investment. So it was not optimal in that sense. So his final question is, the issue of optimal capital flows may be independent of the exchange rate system. So yeah.
Can I address that?
Yes.
Yes. So I love this question. So yes, I think, so what he's saying the idea of capital flows are optimal implies that flows respond to differential rates of return on capital, and hence capital flows to the US are consistent with high US rates of return. So something that I want to point out is that something that is very important is that we have to control for distortions in the different types of markets that we have. So rates of return are not just the observed rates of return, because one thing is the ex-ante rates of return and a different thing is the ex-post rates of return. And then within a model, one can think of different distortions that affect those rates of return, and hence they can ex-post be higher or lower than the ones that you think you are observing. And so yes, it's definitely about differences in rate of return, but controlling for the different distortions in the different types of markets. And then in one of the following questions, Brian points out that is it about, in this sense, the issue of optimal capital flows may be independent of the exchange rate system. So actually, I have a paper with Leo Hanian and Mark Wright where we show that capital flows are mainly driven by distortions in domestic labor markets, actually. And so you can think about a fully real model where the interpretation of the exchange rate is there, because as when I started in the panel, I made the point that it's like having one coin and it has two sides. One side of the coin is the exchange rate and whether they're fixed or flexible. However, to sustain that, whether they're flexible or fixed, you have to impose capital control. So the impediment to international capital mobility is what allows you to keep that system of exchange rate. And so if you have a model, even if it's completely real with no exchange rates, you can think about the behavior of fundamentals or the reactions of fundamentals when you think about what happens to those impediments to international capital mobility. So in this one paper, we show that actually, as I said, labor markets are extremely important for capital flows. And so it's much more than exchange rates, what's going on. The real side of the economy matters a whole lot to explain capital flow.
Thank you very much, Paulina, for your answer. I think there's Ladislau who wanted to say something, or no? Cedric?
Sorry, yes, I was. I think this is essential because the issue is where the money is going. I mean, what is it stimulating? If we take Paulina, I'm using the Brazil example because this is very concrete, but we have 150 million people in working age and only 33 million private formal jobs, 33 million for 150. So the key issue is what you do with these capital flows, whether you stimulate productive activities. So what we commented in the beginning is that the exchange rate and the system that has been used, it is a political choice also internally. They let the real devalue in this system to privilege the great export commodity traders. And this does not create jobs. It makes an environment drama. It's with all the problems. So the key issue for me is, I don't think, Paul, that it is so important whether it is flexible or fixed. If you have an internal strategy for development, and for example, in Brazil, we have reserves of $380 billion. So the government could have influence on the exchange rates. And so you have to close the circle. How the exchange rates, whether flexible or fixed, how they link with what you export and not just whether I'm exporting more, it is better. This is silly. Yes, Brazilians important raw commodities. Yes, and importing oil. I mean, transformed in gasoline, etc. This is surrealistic. You're paralyzing the country. So the key issue for me is, I think this links to what Ashoka was saying, that the key issue is the internal strategy of how you will use the resources, where you will direct, yes, whether it will stimulate productive activities or not. For me, the essence, and I try in my head, to isolate the fixed or flexible exchange. I think it is so linked to the other strategies, to how you organize the whole system. Yes, and then it could have, and we had it in Brazil quite strongly. Yes, very orienting the money to productive investments, and this generated jobs, and you had this reserves creation, and this generated autonomy for exchange rates. So it's a system, and you have to close the circle.
Thank you, Ladislau, for your insights. I think Cedric Thiel would like to say something. He raised his hand. Cedric?
Yeah, thank you, Virgil. One thing I found striking in the discussion is this discussion of peg versus float, but my reading of exchange regime in emerging economies is essentially managed floats. So nobody truly fully floats and only a few completely pegged. And I'd like to hear the panelists on that, because it seems like a regime where you get the best of both worlds. So when things get really out of hand, you intervene, so you go to a peg. But in normal times, you let the exchange rate float and you free the monetary policy to be more in tune with your own domestic needs. And the follow-up to that is, I would be curious to hear about where you see macroprudential policies fitting into that. Because we all agree, I think, that capital flows have become much bigger. They can be disruptive. It's not obvious to me that the exchange rate regime is a perfect way to handle that. But we can have prudential policies, and we have now a fair amount of research showing that they work. So in your view, having a good macroprudential policy toolkit, does it make a stronger case for the benefits of flexible exchange rate or not?
Can I respond to those observations?
Sure.
Okay, so obviously, Cedric, you make a very important point. So there is this very famous paper by Guillermo Calvo and Carmen Reinhardt, which has this very beautiful title, Fear of Floating. And fear of floating makes, I think, the point that your first point, that that countries do not, in practice, especially emerging economies, in practice, let their countries, their currencies float completely freely. The key point, though, there is, and this is the point that I have learned both from my work on Europe and from my recent work on India, is whether there is a political commitment to a certain rate. So if you go back to the Mexican crisis of 1994, the problem was not that there was a there was a so-called crawling peg, which allowed the exchange rate to adjust. But the problem arose because there was a political commitment to adjust. In other words, if you have a commitment, as is currently practiced, say in the Indian context, or in the Korean context, or any of the Asian markets, central banks, they all twiddle around with the exchange rate at the margins. Does that do them long-term good? I don't know. No one has really done a sort of proper study of that. But there is some general perception in central banks in Asia that letting the currency float completely at random will bring some instability, and therefore it is good to modulate it on the margins. But then the studies by people like Klein and Shambaugh, and earlier by Observatoire, say that the trilemma still applies. In other words, you can round the corners a little bit through the managed floating, but you cannot really do very much more than that. It does not, in my reading of the literature, create a fundamental break from the benefits that you derive from floating exchange rates. On the second point, I think you answered your own question very well, that those are two different policies, macroprudential and exchange rate policies. You want both in the toolkit. I think the more sort of general philosophical point I will make is that you do not want to give up a policy tool for some abstract reason. You want to keep the exchange rate as a tool for flexibility whenever you need to use it, and let it serve the purpose for which it is intended.
Thank you.
Can I make
Ashoka,
a very brief point on that?
Yes, please, Paulina.
So regarding that question, so in Latin America, we refer to this as floating with life jackets. And what I think this brings up, which is an important question that I think we still don't have the answer to, is if we're willing to have to float with life jackets as these countries do, then this gives rise to the question of what's the optimal level of international reserves that you should be holding in order to defend your currency if anything were to happen. And so I just kind of want to throw that out there. We don't have a good answer for that, I think. And so this is kind of the issue that one has when you're willing to float with life jackets and be willing to intervene.
Thank you, Paulina, for this for your answer. Any other reaction to the answers provided by Ashoka, Paulina? If not, then I will switch to the following question. Actually, the former question I submitted to you, which was too complicated, has been reformulated by his author. So I submitted to you again. He's asking, depreciation of currency didn't curb importing because imports are inelastic, and on the other hand, export can be increased despite depreciation, as what we experience in Pakistan. So I don't know if this is more, this is clearer. This is more a comment, actually. Any reaction? Then, if not, I will switch to another question of an anonymous question. Ladislau?
Yes, I wanted just to comment. I mean, the key issue is what you're exporting and what you are importing. I mean, I see different countries. I mean, we're exporting raw materials, we're importing manufactured goods and technology and paying patents and things of the kind, you know, and this is creating a new dependency. So it's not just the financial, the monetary balance. It is what kind of impact it generates on the productive system. This is very clear for so many countries where they have to find the balance to pay their debt. So they export oil and they export ore, primary goods, and say we have a new colonialism in this system at a very high technological level. So I think in these questions we have to go down the ladder from the financial movements, the regulations, and down to the impact at the level of the productive system and of the employment it generates. I mean, how it, and I think, Paulina, that in different countries, the impact will be very differentiated, you know, very different according to situations. And the key issue is not adopting one theory or another theory. I mean, flexible is good or fixed is good, things of the kind. You have to recreate this understanding according to moments, according to international situations, according to your internal strategy.
Thank you, Ladislau, for your insights. If there's no other reaction, I will switch to the next question it's anonymous actually. What would it take for the fixed internal euro rate between countries to break up? Anyone? Il y en a beaucoup, il y en a plus d'autres. C'est la dernière.
Virgile, I didn't get the question. Could you repeat it?
Sure. What would it take for the fixed internal euro rates between countries to break up? Yeah. Ashoka?
Well, you know, I was hesitating to jump into this. The short answer is I don't anticipate the euro to break up anytime soon. The fixed exchange rate is clearly inappropriate. It's a rate that works well for Germany, has worked well for Germany for the last 30 years. It's a rate that does not work well for Italy. Italy has now the dual disadvantage of a much overvalued exchange rate and negative productivity growth, which Europeans will argue with me forever. I cannot see how that combination is not lethal from a macroeconomic point of view. And the answer to that has to be some kind of massive transfers to Italy in some form or the other, whether through the central bank or through some other mechanism. Therefore, the question for me is not whether the euro internal exchange rates will cause it to break up. The question for me is, how long is the politics of transfer, which is built into this process, continue, and what will it look like in the coming decade that we are now about to embark on, especially in the post-pandemic, post-Ukraine world, hopefully post-Ukraine world soon. What the pressures within Europe will be, I think that's for anyone to guess right now.
Thank you, Ashoka, for your answer. There's one last question from Eutimio Tiliakos. The problem we have seen before COVID is a structural imbalance among supply of goods and services and demand of goods and services. Flexible exchange rate is or not sufficient to limit such a gap or must be complemented by other instruments. Anyone would like to react?
I cannot comment on this one, so I'll sit it out.
Okay. Oh, no. Elle a dit qu'elle voulait pas.
Well,
Charles?
well, if I understand, your question is whether flexible exchange rate would have helped to fix the bridge between the supply and demand of goods.
Yes, yes, that's more. Yeah.
But I'm not sure exchange rate had anything to do with it. It was a supply chain which was broken by lack of people, lack of transportation, and I don't think interest rates had anything to do with it.
Okay, thank
But
you.
maybe somebody has another view.
Okay, anyone?
So have you finished with the questions?
There's one last question. I mean, it keeps coming. So it's been deleted now. Sorry. No, it has disappeared. So I'm finished with the questions.
Okay, so we are nearing the time we have for this roundtable. I would like to ask each of you panelists, what is the main lesson you drove from the conversation, but also for the last 50 years of experiencing with differentiated exchange rate regimes? Just very, very briefly. I don't know who wants to. I know that Paulina is about to run, so maybe you start. What is the main lesson? If there is something, one takeaway from your research on these issues, what would you say?
So I guess from as you said, from my own research, I think the bottom line is that, as I said at the very start, the political side, the geopolitical side of things, has a lot of influence of what ends up happening at the end. And not only that, but in terms of what's the system that we're willing to adopt, it's largely dictated by that. But at the same time, the real side of the economy matters a lot, and the interaction of the different distortions, especially in labor markets, I want to highlight, matters a lot for the effects of the specific regimes that we adopt from an exchange rate point of view. So we tend to think about this as a purely nominal issue. But at the end of the day, what we have learned in our research is that the real side of things and labor markets really have a lot of impact on the capital flows that result in equilibrium, and hence what results from, the exchange rate regime. So I just want to leave with that.
Thank you very much. It was very clear and very interesting to carry on the conversation, but unfortunately we cannot. I know that you have to run, so thank you for having been with us for this hour and a half.
No, thank you very much.
Who would like to pick up what is the main lesson that he recommends to the audience to keep in mind after this conversation? Ladislau?
Well, my main lesson is that a system based on the dollar is simply outdated. We are beyond Bretton Woods, we are beyond 1971, and the global financial system is a global financial system. There is very little control over it, and this is creating a certain chaos. I mean, this dramatic growth of financial assets relative to a productive basis, this is the key issue. I mean, we must finance what is necessary for development, for environment, for reduction, for productive inclusion, for reduction of inequalities. I mean, money has to become productive again. This is the key issue. I just comment that during the crisis in 2008, yes, we in Brazil just remanaged money towards the bottom of society, which created internal demand because the export was in crisis and the whole system was in crisis, yes, and this created a balance. But this is internal strategy. The key issue is that, I mean, we have global finance, we have no global governance capacity over the financial resources. And this, in my view, it generates the present chaos. The financial system is not helping productive activities. I think Jacques de la Rosière, in our former meeting, had it very clear.
Thank you. Ashoka or Charles, the lesson to be drawn?
Well, thank you. I was very interested by Paulina idea about exchange rate influenced by labor market. This is a very fundamental long-term view. But for me, the floating rate are influenced by the interest rate set up by central banks, and central banks are more and more influenced by politics. The only country which has a real floating currency is a dollar because it is a reserve currency. All the other ones are more or less adjusted by the central banks and interest rates.
That's a very powerful statement. Thank you. And I think in the last panel is about questioning dollarization forever. So I think this has to be carried through to the last panel in 2 weeks' time. Ashoka, closing remarks.
Well, I just want to say that in a policymaker's toolkit, exchange rates policy is one element of it. And we should not expect it to do more than it can, and we should not shut it off either. And that it is the combination of the skill and wisdom with which policymakers use their toolkit, which is ultimately responsible for both material progress and social justice. But floating exchange rates is not where we should be looking for that broader goal.
It's not the Graal. We are hoping in 70s that it was the Graal. It is not the Graal. That's the conclusion maybe. And nothing replaces a wise economic policy and balanced using many instruments, including adequate capital controls if needed, required by the distortion on domestic and international markets. So thank you very much for your presence and your contribution to this series and to this conversation. And there is another link that you have received if you want to exchange a few off-record words. And now, thank you for the participants. I hope that you enjoyed this conversation. And the next meeting is scheduled for next Tuesday at the same time. It will be about how exchange rate regime influenced economic research. And it will be more about economic theory and development in economics as a field of knowledge. So thank you very much for bringing your experience and your thoughts. And maybe come in 5 minutes, we can meet again in the other link to exchange not a cup, not a beer, but at least a few sentences of record. Thank you very much. The seminar is over.
Thank you. Bye.